A family expected a $2 million life insurance payout. When the check arrived, it was $300,000. No missed premiums, no loopholes, no fine print trick. Just a simple, brutal truth. The insurer didn't have enough money to pay what it promised. And here's the part almost no one realizes. This wasn't a freak event. The same flaw exists inside millions of policies across the country. Let's break it down simply. PHL Variable, the insurer at the center of this case, had been under stress for years. But from the outside, everything looked normal. Premiums were collected. Statements went out. Policies were active. What policyholders couldn't see was the quiet restructuring happening behind the scenes. PHL shifted huge blocks of liabilities to reinsurers, including offshore affiliates owned by the same corporate group. On paper, this made the balance sheet look stronger. In reality, no new money entered the system. The risk didn't leave. It just moved from one pocket to another inside the same pair of pants. That's the flaw. The company looked well capitalized, but the real buffer, the cash and assets backing those promises, was much thinner than the numbers suggested. When the pandemic pushed claims higher and investment income stayed low, the weakness accelerated. Losses built quietly. Internal cushions shrank. And eventually, the company crossed into a place regulators could no longer ignore. Once regulators intervene, a different rulebook applies. State guarantee limits kick in, and those limits cap payouts for failed insurers, usually at a few $100,000. That's why a $2 million promise became $300,000. Not because of discretion, not because anyone misbehaved, because the system is designed that way. If your insurer can't pay, the guarantee cap is the ceiling. But the real warning is bigger than PHL. Because what PHL did is not unusual. Hundreds of billions of dollars in U.S. life insurance and annuity liabilities now sit inside companies using the same approach. Move liabilities offshore. Report higher capital. Invest in higher yield, less liquid assets. Maintain thinner buffers. This strategy works in calm markets. It becomes fragile when stress appears. And we already have a second warning. Another private equity-linked insurer was recently downgraded after regulators questioned the collateral backing its offshore reinsurer. Nothing collapsed, but the weakness looked familiar. The protection relied on internal promises, not hard capital. This is the part most policyholders don't know. Life insurance used to be one of the safest financial products in America. Today, a growing share of the industry uses structures that boost returns in good years, but leave families exposed when conditions tighten. PHL's downfall wasn't sudden. It wasn't mysterious. It was the outcome of years of decisions that made the system more profitable and less resilient. A long-term promise backed by short-term cushions. When the structure finally cracked, the loss didn't stay inside the company. It transferred directly to the family waiting for their payout. A $2 million safety net turned into $300K, and millions of similar policies sit inside the same framework today. This is Macro Pulse, Global Notes by JP. Comment, like, share, and hit the bell. Together we build the strongest macro community on the platform.